Welcome back to Tank Talks, everyone. I'm your host, Matt Cohen, and today we're going to change things up a little bit and speak about something that my team and I have been working on with the Build Canada group regarding the changes to Canada's capital gains system and the ways in which we need to reward the risk takers who build Canada. With a new government in Canada, we're hearing a lot of policies being discussed, but one area that really deserves a much closer look is how our capital gains policies stack up against the US. And to discuss this topic today, I have my colleague Jay Lee, who works with us on the team, who worked on this memo with me, and that we have released today with Build Canada. Say hello, Jay.
Hey Matt, thanks for having me. Super excited to chat more about this with you. I think, the reality is, and we've seen it over the last few weeks, is Canada has a very outdated capital gains policy, and it's causing a big problem, right? They're driving away entrepreneurs and investors outside of our ecosystem, and we're just seeing this decreasing number of small businesses despite our population increasing. And a big part of that is because our capital gains tax policies just are less rewarding to founders and investors compared to the US.
I mean, Jay, come on, you're being pretty generous here. It's more than less rewarding. That's an understatement. When you look at the numbers, they're pretty stark. I mean, Canada has only 33 small businesses per 1,000 people over the age of 18, compared to 124 in the US. And that's a massive gap, Jay, and it's only getting worse. A lot of people have been talking about the recent changes in the US government's announced new beautiful bill that revamped its QSBS policy a few weeks ago on July 4th. And now it makes the US capital gains policy even stronger than it was before, right, Jay?
Okay, so let's talk about QSBS so that people really understand, what it is and what's changed in the new bill on July 4th. So QSBS, it stands for Qualified Small Business Stock. It's essentially a policy that eliminates tax on either the first $15 million of qualifying capital gains or 10x your initial investment. So for example, if a VC invested $2 million, 10x that is 20 million. So you essentially pay no tax on the first $20 million of capital gains, whichever's higher. And obviously there's some restrictions here. It has to be a business that's incorporated in the US. You need to hold on to the stock for a certain period of time. But the new bill or the revision to the bill on July 4th changed a few things that made the bill a lot more competitive. So the holding period is now a lot shorter. It used to be a minimum of 5 years, and now you can start earning a bit of the benefit starting from year three. The asset limit has increased from 50 million to 75 million. So a couple businesses that are later in the stage are now eligible, and the exclusion cap increased from 10 million to 15. So no tax at all on the first $15 million in gains, right?
Yeah, I mean, the thing that I always talk about with people when it comes to comparing, our long-term capital gains lifetime exemption versus theirs is that theirs was a 5-year hold and ours was a 2-year hold. Just based on the years of how long it takes startups to even create value, it was almost irrelevant that ours was shorter. The fact that they've now incorporated a sort of truncated approach where 50% of exclusion for 3 years to 4 years is included, 75% is now for 4 to 5 years, and 100% is now included in the capital gains exemption for 5 years plus. But you and I both know, Jay, that startups are not usually exiting in the first 1 to 2 years anyways. So now it
Yeah.
squashes the whole time comparison or arbitrage between the two of our policies. But, Jay, I'm going to pause there and try to let you explain the core issue that this presents to Canadian investors and founders and employees as it relates to our current capital gains policies, okay?
So Matt, the core issue is that our policies simply aren't competitive with what the US is offering, right? In Canada, we have the lifetime capital gains exemption, or the LCGE. And there's this proposed Canadian Entrepreneurs Incentive, or the CEI, but that hasn't actually been put into law yet. So let's just focus on LCGE. And the cap of the LCGE is it allows you to pay no tax on the first $1.25 million in capital gains compared to the US's 15 million. So the US's policy is essentially 15 times greater. And Canada's policy is only applicable to individual taxpayers. So founders or early employees, but VCs or family offices that invest can't claim that credit. So that essentially impacts kind of the returns for VCs, and LPs are looking at returns, and that impacts emerging managers and smaller VCs in Canada to essentially provide meaningful return and, raise their future funds, which overall just makes it a more difficult funding environment in Canada. And that's why, all these founders, new graduates from the University of Toronto, Waterloo, they're all going down south of the border because VCs in the US write bigger checks and they could do it a lot quicker than Canadian ones.
Yeah, but Jay, I'm going to pause you right there because there's something that you and I both researched and learned for the first time that I didn't even know about. And I don't think a lot of other people even know this. But the thing that's the biggest difference between our lifetime capital gains exemption and their qualified small business stock exemption is that ours is a lifetime taxpayer exemption used once. There is a per issuer exemption. That means that the
Yeah.
US QSBS limits are per issuer or per business. This means an entrepreneur, early employee, or investor can use these favorable QSBS policies again and again and again for subsequent companies. That is a huge incentive for repeat entrepreneurs who are statistically higher at having a chance of more success building their second and third and fourth company. And the kicker is that investors can't claim lifetime capital gains exemptions, but can claim QSBS with a clause that lets you deduct either the first 15 million in capital gains or 10x your investment. So let's play VC math here for a second. A VC that invests $3 million gets 100% tax shielded on their first $30 million out after the 5 years. That's huge. This is a massive impact on venture returns. This creates, no pun intended, a ripple effect, where LPs are seeing higher returns from US VCs. They prefer funding US funds over Canadian funds. US VCs have more LP capital then to recycle and get more capital back into their next funds. And honestly, the liquidity to invest after they get their money back goes back into more startups. And this means that US VCs can write larger checks, and Canadian founders and businesses who need funding more often than not are having an easier time raising from US VCs who are less risk averse than the Canadian ones who are slower sometimes and have less capital to play with.
Yeah, I mean, that's exactly right. Like when we were working on the Build Canada memo, we did the model, right? If we looked at a business that sold for potentially 100 million, let's say, uh, they would essentially have to pay, they as in the early investors, the early employees, the founders, they'd have to pay almost $15 million in taxes if it was incorporated in Canada. That same business, that same value exit valuation in the US, zero taxes. So that's $15 million less in repeat founders investing into their next business or becoming angels or becoming LPs into emerging managers. 15 million less that goes back into our ecosystem and goes into the US ecosystem instead.
Yeah, and we're not just talking about like tech startups. We're talking about SMBs, small medium businesses that drive the economy forward. That this would benefit. I mean, it's almost like you're basically creating a penalty for success in Canada. You build one successful company, and then you're significantly less incentivized to continue to build a second or third in Canada because you've used that lifetime capital gains exemption. Whereas in the U.S., you're incentivized to continue to do it. This means basically that Canada's best talent is often driven to leave and start businesses elsewhere where they can find easier access to funding and keep more of the upside if they succeed. And we're already seeing this in our own portfolio. We've had many early stage companies that raise money from US investors that we introduce them to who are putting clauses into the deals that say we require Canadian businesses to reincorporate in the US as a Delaware C Corp just to be eligible for QSBS. So our best entrepreneurs and companies are leaving the country just to take advantage of these rules. And, we can't really do anything about it because we want the companies to succeed. We're not going to stop a founder from raising great quality capital from great partners just because they are not going to stay as a CCPC, a Canadian controlled private corporation. And these policies really, Jay, make it less valuable for investors to put money into Canadian businesses, making capital more scarce here, and this basically affects the earliest stages the worst. We're talking pre-seed, seed, Series A and Series B investments. And, Canadian founders are just really struggling with less capital to use to create the next business and also recycle the wins into becoming angel investors and these founders wanting to become LPs and emerging managers. And this is how the ecosystem kind of repays itself with the ability to have more capital to reinvest. And so unfortunately, VCs have just less after-tax returns to show to their LPs, which basically means less potential future funds. And the small business ecosystem doesn't end up growing. And this is a systematic issue that makes it difficult for SMBs to get started, let alone scale, which ultimately impacts our GDP, right? And that's what we care about. It impacts job creation, productivity growth, and we have such a highly educated population with world-renowned research labs that if we don't reward the risk takers, they're going to build elsewhere.
Yeah, but the thing is, Matt, like we saw that the difference between the capital gains tax um, that you pay, in Canada compared to the US, it actually significantly narrows as the exit valuation increases. So if a business is sold for 250 million or 500 million instead of 100 million, that gap narrows a lot. And that's because 100% of every additional dollar in capital gains above the QSBS limit, whether it's $15 million or 10x the initial investment, is all of that is subject to taxes in the US. But in Canada, you only pay tax on 50% of your capital gains. So basically, what that means is you and I were talking about this is if Canada creates a similar competitive capital gains policy like QSB, then it could actually give the Canadian policy an edge, right? But if we leave the policy the way it is now, we just won't be competitive. And you talked about, some of the US funds that we're seeing asking Canadian founders and companies to reincorporate. It's essentially like the way I see it is it's essentially a call option that the US or the IRS, takes on Canadian, but also global founders, right? They give that tax break on the first $15 million. It helps secure the tax on capital gains over that limit because when they reincorporate, and when they actually do sell, that entire capital gains is paid to the IRS. If you think about it, like Canadian success stories, Shopify, Clio, Slack, they all relocated outside of Canada, or they only received, investment from Canadian firms or companies after they scaled their business, after they essentially de-risked it from the early stages. And I think we probably need a policy like QSBS to increase investment into Canadian businesses and keep our best founders and best businesses in the country.
Yeah, and I mean, like Shopify is famously known for trying to keep their CCPC status at their Series C round, which John Ruffalo from the podcast, did the deal because they were Canadian investors and that kept their CCPC status. So people are thinking about this all the time, but eventually, when push comes to shove, you can't really compete when ours is 1.25 or maybe going up to say 1.5 eventually to 15 million. Like it's just there's no comparison for that. And that's exactly what we're working on with Build Canada here. This policy memo recommends combining the long-term capital gains exemption and upcoming CEI into a simple, powerful capital gains policy that supports entrepreneurs. We're talking about expanding the eligibility requirements, including all industries that are of national interest. You're talking healthcare clinics, clean energy, and eliminating the minimum ownership requirements so that all individuals and corporate entities can claim these deductions. We also are recommending improving the capital gains and inclusion rate, raising the inclusion cap to 15 million or 10x adjusted cost base per taxpayer, whichever is greater, to basically match the US policy, and also making some structural changes. This includes amending the capital gains limit from applying to a per lifetime to per business to incentivize repeat entrepreneurs and ensuring common investment structures like a SAFE, a simple agreement for future equity, and convertible notes are eligible, with the holding period starting from the date of the investment being signed, not when it's converted into actual equity.
Yeah, exactly. I think it's like that policy memo that we've worked on. I think it's all about just fostering this ecosystem in Canada where risk taking and entrepreneurship is rewarded, right? And it's not penalized. And it's ensuring that all of our like young, skilled workers and talent and graduates and innovators, they stay and build their companies in Canada and they don't go down, south of the border. And all of that, increase in investment and keeping our businesses here, it creates more jobs, it drives up wages, and ultimately, like when the job market gets better because more companies are staying, it helps reduce the strain on some of our social programs. And I think it's also just about keeping our most promising businesses here so that when the next $1 billion, unicorn sells their business, the capital gains goes to the CRA and it goes towards funding the next wave of Canadian builders or startups and investors. And it's not going to the IRS.
Right. It's all about funding the next wave of Canadian builders, startups, and investors in Canada. Exactly, Jay. And it's about ensuring that Canada is the place where entrepreneurs want to plug their nose and jump with both feet first. Knowing that they have a competitive chance to succeed and be rewarded for it. Without this, Canada risks losing its competitive edge in attracting both capital and talent. So thanks everyone for listening and for reading our memo. And remember, let's all push for Canadian QSBS 2.0 that accelerates growth, fuels innovation, and keeps our ecosystem thriving. Please read and reshare this memo with every Canadian entrepreneur, investor, and operator to get the word out that we need to reward the risk takers who build Canada. Thanks for jumping in the tank with us today, Jay.
Thanks, Matt.